At some point, almost every renter asks themselves the same question: am I ready to buy a home? Maybe you've been saving for a while. Maybe your lease is coming up and you're tired of throwing money at rent every month. Maybe everyone around you seems to be buying and you're wondering if you're falling behind. But here's the thing: buying a home before you're truly ready can set you back financially for years. And waiting too long when you're ready means leaving money on the table. My name is Robert Portal and I am a home loan advisor. My team and I have helped hundreds of families across the nation navigate the home buying process while making it stress free. Today, we're going to walk through exactly how to know when you're ready to buy your first home. We're talking finance, mindset, lifestyle, all of it. By the end of this video, you'll have a clear picture of where you stand and what to do next. Let's get into it. Sign one: your credit score is in good shape. The first thing lenders look at when you apply for a home mortgage is your credit score. You see, it affects whether you get approved, what interest rate you receive, and ultimately how much monthly payment will be. A difference of even 0.5% in your rate can mean tens of thousands of dollars over the life of your loan. So, what score do you need? Here's the general breakdown. 580 or above, you may qualify for an FHA loan with 3.5% down payment. 620 or above, you open the door to most conventional loan programs. 740 and above, this is where you start unlocking the best rates available. If your score is below 620 right now, that doesn't mean homeownership is off the table. It just means you may need a few months to build it up before you apply. The good news is that credit scores can move relatively quickly with the right habits. Paying down credit card balances, making every payment on time, and avoiding opening new lines of credit are the three biggest levers you can pull. Pull your credit report before you ever talk to a lender. Know your number. And if it needs work, make a plan, because even a 20 or 30 point improvement could save you a significant amount of money over the life of your loan. Sign two: you have enough saved, and not just for down payment. A lot of first-time buyers think readiness comes down to one number: the down payment. But as we've talked about on this channel before, your down payment is only part of what you need. Here's what you actually need to have saved before you buy. Down payment, this can range anywhere from 3 to 20% depending on your loan type. So on a $400,000 home, that's anywhere between $12,000 to $80,000. Closing costs, typically 2 to 5% of the loan amount. So budget for this separately. Cash reserves, and most lenders want to see that after closing, you still have money in the bank. 2 to 3 months of mortgage payments as a reserve is a common benchmark. Emergency fund, this is separate from reserves. Homeownership comes with surprise expenses: a broken water heater, a leaky roof, an HVAC issue. If buying a home would wipe out your entire savings, you're not ready just yet. And that's okay. Give yourself a timeline and a savings target. The question to ask yourself isn't just, do I have enough down payment? It's, do I have enough for a down payment, closing costs, reserves, and an emergency fund? If the answer is yes, that's a really strong sign you're financially ready. Sign three: your debt to income ratio is manageable. Your debt to income ratio, or DTI, is one of the most important numbers in the mortgage process, and most first time buyers have never even heard of it. Here's how it works: a lender takes all of your monthly debt payments, car loans, student loans, credit cards, personal loans, and adds your projected mortgage payment on top. Then they divide that total by your gross monthly income. The result is your DTI. Most lenders want to see a DTI of 43% or below. Some loan programs allow you up to 50%, but the lower your DTI, the better your chances of approval and the more comfortable your financial life will be as a homeowner. So if you're carrying a lot of debt right now, especially high car payments or a significant credit card balance, it may be worth paying some of that down before you apply for a mortgage. Not only does it improve your DTI, it can also improve your credit score. Run a quick estimate on your own. Add up all your monthly debt payments, add in what you expect your mortgage payment to be, and divide that by your gross monthly income. If that number is over 43%, that's a signal to pay down some debt before you start the home buying process. Sign four: you have stable income and employment. Lenders want to see that you have a reliable, consistent source of income. Generally speaking, they want to see at least 2 years of employment history in the same field. That doesn't mean you have to have been at the same job for 2 years. Job changes within the same industry are usually fine. What raises red flags is switching careers, going from employed to self-employed, or having large gaps in your employment history. If you're self-employed, you can absolutely qualify for a mortgage, but you will typically need 2 years of tax returns showing consistent income, and the process may require a bit more documentation. The question to ask yourself is this: is my income stable, predictable, and likely to continue? If the answer is yes, you're in good shape. If you're in the middle of a job transition, considering going freelance, or your income is inconsistent, it may be worth wait until things stabilize before applying. Quick pause: if you're getting value out of this video, go ahead and subscribe. We drop new videos every week breaking down the home buying process specifically for first-time buyers in plain English with no fluff. It's free and it could save you thousands of dollars. All right, let's keep going. Sign number 5, you're ready to stay put for a few years. Buying a home is not like renting. You can't just give 30 days notice and move on. And if you sell too soon, you can actually lose money, even if your home's value went up. And here's why. When you buy a home, you pay closing costs. When you sell a home, you pay agent commissions and closing costs again. That's typically 8 to 10% of the home's value in the transaction costs combined. Your home needs to appreciate enough to cover these costs before you even break even. Most financial advisors suggest staying in a home for at least 3 to 5 years to make the purchase financially worth it. So ask yourself honestly, where do I see myself in 5 years? Is my job stable in the city? Am I in a relationship that's settled? Are there life changes in the horizon? A new job in another city? Plans to start a family that might require more space that could affect where I want to live? If you're confident you're planning routes for at least a few years, that is a strong sign that you're ready. If your life feels a little uncertain or transitional right now, renting a little longer may actually be the smarter financial move. Sign 6, you understand the full responsibility of home ownership. This one is less about finances and more about mindset, but it matters just as much. You see, when you own a home, you are responsible for everything. There's no landlord to call when the water heater goes out at midnight. Property manager to handle the pest problem. If something breaks, it's on you, financially and logistically. That can feel overwhelming at first, but the buyers who thrive are the ones who go in with realistic expectations. So ask yourself, do I understand that homeownership comes with ongoing costs beyond my mortgage payment? Am I prepared to handle unexpected repairs, financially and emotionally? Do I actually want the responsibilities that come with owning a home? Or am I buying because I feel like I'm supposed to? That last question is more important than people give credit for. Buying a home because of social pressure, because your parents did it, because your friends are doing it, or because you feel behind, not a good enough reason on its own. You should want this. You should be ready for it. The financial benefits of homeownership are real and powerful, but only if you're in the right situation to take advantage of them. Sign number 7, you talk to a lender and know what you can afford. This is a step most people put off, and it's actually the one you should do first. A lot of first-time buyers spend months browsing homes on Zillow before they ever talk to a lender, and then they find out they can't qualify for significantly less than they thought, or more. Either way, they've been shopping in the dark. Getting pre-approved by a lender is one of the most important early steps in the home buying process. It tells you exactly how much you can borrow, what your estimated payment would be, and whether there are any issues with your credit or income that needs to be addressed before you apply. It also puts you in a much stronger position when you find a home you want to make an offer on. Sellers take pre-approved buyers much more seriously than buyers who haven't even talked to a lender yet. Here's something people don't realize. Getting pre-approved doesn't obligate you to buy anything. It's just information. It's a snapshot of where you stand right now. So if you haven't done it yet, make that call. It's one of the best things you can do to move from wondering if you're ready to actually knowing. Recap and next steps. All right, let's bring it all together. Here are the 7 signs that you're ready to buy your first home. 1, your credit score is in good shape. Ideally 620 or above, with 740 being the sweet spot for the best rates. 2, you have enough saved for your down payment, closing costs, reserves, and an emergency fund. 3, your debt to income ratio is at or below 43%. 4, you have stable, consistent income and at least 2 years of employment history in your field. 5, you're ready and willing to stay in one place for at least 3 to 5 years. 6, you understand and accept the full responsibility of homeownership, not just the financial ones. 7, you've talked to a lender, gotten pre-approved, and know exactly what you can afford. If you checked off most of these boxes, you're probably more ready than you think. If a few of them gave you pause, now you know exactly what to work on and in what order. Drop a comment below and tell me which one of these are you working on right now. I read every comment and I'd love to help point you in the right direction. And if you haven't subscribed yet, now it's a great time. We post every week and our whole goal is to help first-time home buyers like you get to the closing table with confidence. See you in the next one.